So we're looking at the Nasdaq gap continuation. Challenging day yesterday. Let's get a perspective of the last 12 months, past year, what it's done. Big gains for a single Nasdaq contract for one strategy. $6,500 close trade to close trade drawdown. Only 21% profitable. A lot of losers in a row. 20 was a maximum consecutive losers. We hit that max consecutive losers. We also hit this max drawdown yesterday. This is just over the past year. And in general, $300 stop loss is pretty tight. We've talked about a bigger stop loss. And you see this equity curve just straight flat down. This strategy is an aggressive version of gap continuation. 2020 is not in the other most of the portfolios. It's in the stock index and gold. I want to give you perspective though. What would happen if you did the opposite? We saw the Nasdaq just bouncing every time it hit a new low. Really extreme, just bounce, 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 bounce. I mean, buying lows, catching falling knives is not a good way to trade most of the time. Every now and then it works like a charm, and it will lure you into a false sense of a strategy. But you just see the market hitting new lows and bouncing, hitting new lows and bouncing, hitting new lows over and over. Almost a low here, bounced. Hit a lot of new lows and bounced pretty high if you have tight profit targets. But then it did it repeatedly throughout the day. So catching falling knives was the MO yesterday in the Nasdaq. It just really fairly impressive bounce in the close, but in reality that's 11,089. We were up near 12,500, so 1,500 points off the highs. Wanted to show you what would you do if you trade the opposite of this strategy. So here is the opposite entry. We use a $300 profit target instead of a $300 stop loss. And the opposite of this would be to not have a stop loss, because a stop loss, this strategy, the gap continuation strategy, does not have a profit target. So the opposite of not having a profit target would be to have a stop loss. So what we do instead is we do have a stop loss of 700. We use a $700 stop loss, a $300 profit target instead of a $300 profit target, and no stop loss, which would be the opposite. Here are the results. So we've talked about this. This is continuing with our theme of chopper, a chopper strategy that went parabolic. Now at the end of July, we just see the maximum extreme. We're talking about market behavior here, mean reversion of market behavior. So it doesn't usually. I mean, this would have had its best day yesterday. If you did the exact opposite of gap continuation, it would have had its best day in, I guess, 5 months is how far back this goes. And so we're talking about mean reversion in this video of market behavior. Catching falling knives doesn't typically work that well. And you see that it just did absolutely amazing yesterday. Best day in 5 months, while gap continuation has worst day in 12 months. And so yeah, mean reversion of market behavior is what we're focused on, and how we don't expect the market to continue to act like this because it's so rare for it to act like this so well. We saw this in chopper. Even our chopper strategy had a, here's what I'm talking about. Here was chopper Nasdaq. We saw this kind of go parabolic, this equity curve go parabolic, and now this strategy, the chopper strategy, which defined the chop, has come back a little bit. And so mean reversion of price would mean that if the price quickly goes up, then it comes back down. Mean reversion of market behavior means that if it goes from a trendy market to a choppy market, to a trendy market to a choppy market, trendy market, choppy, you get it. And then we've had an extreme amount of chop. So this is chop, 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 extended chop. And so the theory behind this is the longer you have a chop, the more explosive the trend will be, one way or the other. And that's old theory. That's theory that most of us know that have been trading for a while. And so we've had just maximal amount of chop in this market. And so if you have a price pattern in the market where the market just kind of goes parabolic, well, that's not going to keep going parabolic. It's going to mean revert and then chop. And so you have a mean reversion of price and market behavior. So if you have, in this example, a strategy that defines, if you have a strategy that defines a market behavior of chop, like chopper did, it went parabolic. And so we have this parabolic move and then mean reversion of the equity curve on this market behavior would represent potentially more trend. Yesterday, we had this pullback in this trend. It doesn't represent trend. It's still more chop, but it's a different kind of chop. And so there's many different ways to define chop. And in general, we are in massive chop mode and at the end of the month and looking for some mean reversion of market behavior, not necessarily price behavior, but market behavior to go from trending to chopping. Wanted to share that with you. Thought it was interesting to note how a strategy could do this well by catching a falling knife. And so looking for that as we start November. First trade tomorrow evening on Sunday night.